Hi, everybody. I'm Hannah. I'm going to be presenting or hosting the panel discussion tonight. We've got a few things that we're going to be covering off as we get started, and we've got a little bit of admin. We are going to be recording tonight's session. If it glitches out at your end, you'll be able to get access to the titillating material that we'll present to you. Charlotte, can I just have confirmation that you can see and hear me, please?
Yes, I can, Hannah.
Great, thank you. Okay, so we're just going to wait another 30 seconds. There are a few people still coming in the door. Pretty excited to have Ashley Church here with us and to also introduce to you Momentum Realty, which is our property company that helps us as financial advisors and coaches match your property needs with stock they've got available. So it's pretty exciting for us. But there's a little bit that we'll be covering off around that. But I think we'll get started now, please, Charlotte. So I guess tonight's seminar is for informational purposes only. We're going to be having at times a bit of a debate, but certainly answering a lot of the questions that have come in from you as our clients around the property market. Whether that information is pertinent to your particular situation is something that we need to work with on a one-on-one basis, but we'll try and cover off some of those questions, or as many as we can as possible, and the rest you'll be able to pick up with your coach. I'm going to be introducing you now to Ashley Church, who is a property commentator, and also Hamish Cowan. Ashley is a bit of a legend, to be honest. I'm really excited to have him here. He is the ex-CEO of the Property Institute of New Zealand. He is a sought-after commentator for One Roof, The Herald, ZB, The AM Show. But what I like especially about Ashley is he fosters intelligent debate using data and his experience to interpret that data. And data can cut through a whole lot of emotion. So I'm very pleased to welcome Ashley. And we've also got Hamish, who runs our property team, which is trading as Momentum Realty. We're launching Momentum Realty this month, so that's its own separate property business. Obviously, he's got separate terms and conditions he needs to go through with you from a disclosure perspective, but I wanted you to put a face to the name, and he's going to be talking about some of the stock and properties that we are accessing for clients and some of the benefits if you're going to be using them.
Hi, guys.
So I guess we're going to be, Ashley and I are going to be debating, discussing, working through some of the myriad of questions you've all sent in ahead of today's session. Some of the biggest questions, I guess, and there definitely is a theme, we're going to be coming to this all in about 5 minutes once we've just wrapped up the momentum side of things. But some of the big questions that are coming out is now a good time to invest in property? I mean, it feels pretty volatile, right? So should we be holding off, or should we be going all in? I think some of those answers are situational, but there are some components that you can apply to your own investment strategy that is really important, and Ashley and I are going to be debating those. Some people have asked whether it's appropriate to be investing in property if you're entering retirement. We're going to talk about that. The impact of things like tax policies, yields, whether you should be buying in particular areas. We're going to cover off all of that and a few more questions as well. I think you're going to find it interesting, and well, I certainly hope you find it interesting and you find value from being with us for the next 30 to 40 minutes. If we can just pass over briefly to Hamish, who's going to talk about momentum and some things that you can look forward to receiving if you were to work with momentum. Over to you, Hamish.
Good one. Thank you, Hannah. Yeah, further to that, yeah, like Hannah mentioned, we're really excited this month officially to launch Momentum Realty. So we are licensed under the REA. So our remit is to list and sell real estate. And I guess one of the exciting things for Momentum is being part of the Enable Me group, but a standalone business, is the fact that we can use the Enable Me insights to reach out to vendor partners to then source stock, property stock that suits the Enable Me investment criteria, which is a key point of difference. Just want to head to the next slide, Charlotte. Yeah, we're super excited in the real estate space, to grow the business. We have been positioning the real estate business for growth. So we really are scaling up both in, customer service and delivery, but also in personnel. So as you see on the screen there, you've got myself still running the team. I've been with the group for 14 years, running the property business for the last 4. And also still current GEM of the Momentum Realty business. We've got a new licensee agent, Louise Skinner. She brings to the team 15 years experience as a licensee agent selling real estate. We've also got 2 new licensee salespeople, new to the team, but not new to the industry. Craig Rawcliffe's got 20 years experience selling real estate in the Hawke's Bay. So very excited to have Craig on board. And also, Georgia Featherston, she's got 15 years selling real estate in Auckland with city sales, so apartments and townhouses off the plan, which is exciting. And also we've got Jordan Gosden, who's worked with Barfoot's in an EA and customer support perspective. So super excited to have that breadth and depth of experience, and looking forward to be able to provide a fantastic service for the Enable Me clients that are looking to purchase investment properties. So that's the team. So why work with Momentum? As I mentioned, what's quite cool about Momentum is we are a standalone licensee agency, but we have been founded for the express purpose of marketing properties that we know suit the Enable Me New Zealand's investment criteria. So we use that and reach out to vendors, and the rules of engagement, I guess, for working with us as an agency is to ensure that the stock meets the investment criteria. So I think that's also covered off on the next slide. So what that means is we go to market as an agency and say, what can you produce that would suit our specific criteria, which is your buying in growth areas. We're talking 10-year master build or other guarantees. We ensure that all of our products are full rent ready, which obviously as investors, that's what you want. We advocate, for fee simple freehold properties as standard, but also have the ability to access unit title apartments, if they're located in superior locations. So I guess that's just a bit about Momentum. As I said, officially launched this month. We are working hard to source great stock for the Enable Me team. And I guess another reason, the benefit of working with Momentum is that interplay between your Enable Me coach, sorting out your financial criteria. Obviously, under the Enable Me program, you've also got access to a specialist property coach, being Suzanne Hill, and then the ability for us to interplay and work together for the purchaser's interest to find a property that suits your investment criteria. So hopefully that's you've learned a bit tonight. And as I said, we're super excited to be able to be a part of the team and to list and sell real estate and bring property to you that suits your criteria. And yeah, we work with only a select number of vendors. So I'm sure you're aware you can jump on Trade Me. There's plenty of people trying to build new properties, but we work with a select number of vendors that meet that strict criteria. So we're talking, people that can build at scale. They've got, strong procurement lines. They've got good delivery. They've got good communication. So here's just a selection. So obviously GJ is well known. Wolfbrook are well known in Christchurch and growing. They build about 300 homes a year. So looking forward to working with them. They offer things like fixed price guarantees, healthy homes guarantees, rental guarantees, which is exciting. And similar to Inspire, they build nationwide and also have a nationwide network of property management businesses which help. And also to Silver Builders, we've sold down a number of their developments. They also offer master build guarantees and rental guarantees. So again, just being able to work close with our vendor partners to secure stock that we know will suit the Enable Me's investment criteria is a big part of, I guess, what we're doing over the next month or so. And we look forward to, I guess, working with you all over the next period of time and bringing those properties to you to work through with you and your Enable Me coach.
Thanks, Hamish. I think that the key there for any retirement planning is to understand what is the property criteria, what do you need from your property and the rest of your plan. So we want to know, what is the capital growth rate that your plan is requiring? What is the yield you need? What is the top up you can afford based on different scenarios? Because we're trying to increase the probability of you getting the growth you need and being able to hold long enough for you to see that growth. And there's a bit of science behind that, but it's helpful for me as a financial advisor, once I've determined that criteria, to then go and waddle next door to the property team, which is called Momentum, and say, well, this is the criteria I need for my client. Of course, they could buy any old property if they wanted to, but we're trying to increase the probability of that property giving you the return that you need to solve your problem. So that's good. But from here, thank you, Hamish. From here, Ashley and I are going to be discussing / debating certain topics as it relates to property. So, Hamish, I might just get you to take your video off if that's okay. So the first question that we are getting a lot of, Ashley, is now a good time to be investing in property? I certainly have my view, but I'm keen to throw it over to you to see what you're thinking on that.
So the corollary of that, hi Hannah, the corollary of that is that is a theory that somehow people are in a position where they can actually pick when is a good and not a good time. And so in theory, that means that there would be periods of time when people would think that they shouldn't be buying and should wait until a theoretical time when it's the right time to buy. The problem with that theory, you know, I've encountered people in all different levels of property purchasing over the last 20 years. Young people looking to buy their first home, property investors, and people in the middle. Is that it's based on, as I say, this assumption that people can pick the market. It just doesn't happen. And you know, as I've said in a few other forums, the rocks of disappointment are littered with the bodies of people who thought they could pick the timing of the market. And so for me, I've always worked on the basis that the market's relatively predictable, and it does predictable things over a long period of time. And that the way to make wealth out of property investment is to stay with it for a long period of time, and therefore with the precise timing of when you buy is much less important than the period of time in which you stay in the market. So on that basis, I wouldn't be too frantic about trying to pick the exact time and get the exact price and time the market in the exact way. I'd be much more motivated about getting into the market and making sure I was there for the duration.
And I guess that the idea of delaying is coming with its own set of challenges as well, right? Because we know that interest rates are increasing and banks are testing on higher servicing rates. So
Yep.
You're going to qualify for less borrowing, even if the longer you wait,
Yes.
which for our clients that have a retirement gap that they're trying to solve through capital gain, the more you spend on a property, in theory, the higher the capital gain, if we say that it doubles or increases based relative on its original purchase price. If you have lowered that purchase price because you can't qualify for as much borrowings because the lending conditions have worsened, although your stomach for doing something has strengthened, you actually are shooting yourself in the foot inadvertently. So it does.
All of that's correct. And I guess that even at a more simplistic level, there'll be people probably listening now who are thinking to themselves, oh, but the market's about to crash, or you know, that the market's dropping and everything I'm reading in the media is telling me that prices are dropping and therefore this would be a silly time to buy. And look, this isn't the first time during the period of time that I've been commentating on the market that there have been predictions of doom with regard to what's going to happen to the market. My very clear view is that what we're going through right now, Hannah, is momentary, by which I mean it's right now. It might be the next 3 or 4 months, but in 6 months' time, we'll be talking about something different. And probably the best example of that would be that 6 months, 9 months ago, we were talking about FOMO. We were talking about the market being overpriced and having to get in, or you were going to miss out, and a panic about people thinking that if they didn't get into the market as soon as possible, that they were going to lose the opportunity to participate in the market. So that change has taken place in a very short period of time. And it's just as likely that will happen again over the next 6 to 12 months, and that we'll see not necessarily a return to the heady days of 9 months ago, but certainly a settling out in the market. So folk who are sitting there right now thinking, hey, the market's going to crash and I just need to wait and see what's going to happen over the next 12 months. If history is any indication of what's likely to happen going forward, will find themselves sorely disappointed.
Got it. We've had a lot of people ask, is it a good time to be investing in property if, for example, you are approaching retirement? Because often that strategy, when you're young and you've got time on your side, you can lean more into growing wealth. But when you're approaching retirement, it tends to be more about cash flow, right? The certainty of income. What would your views be, I guess, or in response to that question?
Well, the answer is yes, but it's somewhat situational, by which I mean that there will be some people for whom that's actually quite a pressing question right now, who maybe haven't made provision for themselves, who are only now maybe in their early 50s or even older, who are looking to see what provision they can make for themselves, and who may not have the resource to get into the market, or indeed if they do, may not be able to get the immediate returns that they would require once they retire to provide them with an ongoing income. But there'll be other people, keeping in mind that we're living much longer now. Longevity is a lot more than it was even 30 years ago. There'll be people who retire at 65 who could still be kicking in quite active at 85 or even 90. And so for those folk, if you're getting into the market, if you've got the resource and the ability to get into the market, and you've got another 20, 25 years ahead of you in terms of what you might do with your life over that period of time, then absolutely it's a good time to get into property investment, because it will continue over that 20-year period to do what it's done over the last 20 or 30 years, and that is progressively increase in value, and the income that it generates for you over that period of time will increase as a proportion of the value of the property. So yeah, it would be more difficult for somebody who was close to retirement, who was just starting to look at this now, but even for those people, even 4 or 5 years of capital growth is going to put them in a better position than they were in had they not done anything.
And for those who possibly don't need capital growth, like they have got enough money, the more certainty around income is helpful as you move into that next stage, right? Stable
Absolutely.
income that's increasing with inflation is helpful, and if the base asset's maintaining its value, then that's of comfort as well. I guess the focus there could be more on the yield, the rental income relative to the purchase price. That might be something that does change as you move to less income coming into your general household when you stop working. We've had some questions around where's a really good place to buy. So when we analyze and we're trying to work out what's the capital growth rate we need to solve the problem for a customer's situation, it pops out, well, that we need a growth rate of no less than this if it's going to solve that problem within an X period of time with what you've got to work with. But it's interesting, right? Because different regions have different growth rates. That's changing over time as well. And then different types of properties, the number of bedrooms can also impact the growth rates as well. But if we start generally, what's your response to where do you buy? Like, is the golden triangle the place? Because we've always said
I defer to your data in respect of yield. So I absolutely respect that your data will probably get a better idea in respect of yield. So I look at it probably more holistically in respect, I suppose, for me, because it's always been much more about capital growth for me. If you were to ask that question 20 years ago, you would have got a different answer to the answer that you might get now. And I was saying to somebody earlier that the Herald published an article about a year ago where they were talking about what parts of the country did best if you'd invested in a house back in 2000. And interestingly, the area that had the best growth, and it was 508%, was actually the Mackenzie country. Twizel and Temuka and down that way, and nobody could have known that. Nobody could have guessed that. But back then, it was actually quite important that you look for the right areas where you were getting, as you say, good yield, and you were getting good capital growth. The thing that's changed over the last probably 10 years, and probably actually been amplified as a result of COVID and some of the work practices that have taken place, is that it's almost impossible to do badly in pretty much any part of the country now if you're focusing purely on capital growth. I respect, as you were saying before, that yields are different in some parts of the country, but if you're looking at capital growth alone, it's become a much more benign market. It's actually very difficult to make a mistake, and I'm a really good example of that. I live in Hawke's Bay. I moved from Auckland 2 years ago to Hawke's Bay, and I operate a business from here, and I'm able to do that. I've got an airport just down the road, but the reason I'm able to do that now in a way that I wasn't able to even 10 years ago is because of the internet. So the internet has leveled not just the way in which we conduct business, but the way in which we invest in property and which people choose to live. And I think you'll see that over the next 10 or 15 or 20 years, that the nature of the way that people live and the lifestyle choices that they make mean that the traditional destinations that people would have wanted to invest in for capital growth and yield are probably less important than they might have been in the past.
And I guess the challenge, though, for that, just to be balanced with that, is It's about being able to hold the property until you get the gain. Because as we know, the growth isn't linear generally. It can be a weird shape, but we need you to be able to hold. And so trying to stabilize your situation and try and neutralize the cash draw of that investment property becomes the next step in protecting your flank so that you're more likely to get the gain out the other side.
Oh, look, I couldn't agree more. And it's interesting because the data that tells us what's happened to the New Zealand property market now goes back to about 1970. And it's interesting because between 1970 and 1975, house values in New Zealand basically doubled. It was the first modern property boom that we'd had. And then between 1975 and 1980, they crashed by 38%. Which was scary, I'd imagine. I wasn't around at the time. Well, I was, but I wasn't investing. But from 1980 onward, it's been basically a trajectory upward. But as you say, it's not been a straight line. It's been a bit like the teeth of a serrated saw, where the market's sort of going up and down all the time. And sometimes it takes a little bit more of a dip, as it did during the GFC. But the trend of that serrated saw is upward, the blades pushing upward. And we've now got 40 years of data from 1980 that shows us very, very clearly that trend is a consistent one. So I have people say to me, well, that's great and that's fine, but past performance isn't a guarantee of future performance. And look, that's true. It's not. You can't absolutely guarantee that because that happened over the last 40 years that it's going to happen going forward, but you would be pretty foolish to ignore that trend. And so I work on the basis that it may not be exactly what it's been over the last 10, 20, 30, 40 years, but it's highly likely to continue in that direction, maybe albeit at a slightly slower rate than it's done in the past. So you're right, it's about getting into the market, staying with it for a long time and taking advantage of that.
And the comparisons I think that people fail to make when they might be discussing perhaps the volatility of the investment market, the investment property market, is, well, if the investment property market is volatile, property is the least volatile of all assets. So you've got to be looking at your other options, and you would be able to see that there is more volatility happening with those relative to property.
Totally. It's interesting. And there are people who swear by the share market. There are people who swear by cryptocurrency. There's a whole range of things, currency exchange. There's a whole range of things that people do. And I don't claim to be a specialist in any of those. And I don't doubt that there's good money to be made and that there's great opportunity. But the risk is also that much greater. In all of those, the share market, as I understand it, its long-term trajectory is actually very positive, but it has very, very big falls and very, 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 very big increases in a way that the property market just doesn't. We're panic at the moment because, and this is interesting, given the headlines that we're reading right now about falls in house prices, the median house price across the country, last time I looked at the figures, had dropped by about 3% since at the end of 2021. And if you were to read the headlines, you'd think that sort of plunged 20. And so, we're panicking around numbers around those sort of margins. And it may go a little bit further, don't get me wrong. It may well drop. In 2008, 2009, the Auckland market dropped by 8 or 9% and stayed down at that level for a year or two before it took off again. But it did take off again. And it eclipsed those losses very quickly after that, and the market continued to make gains. People who invest in the share market, just to choose one example, can have quite a strong trajectory of 2 or 3 years, and then a plunge in the value of those shares that can take years to recover from. So for me, because I'm not particularly smart, I prefer things that are easy to understand and I can focus on, and that have got a track record over a long period of time of being relatively risk-free. And when I say risk-free, I don't mean there's no risk involved in property investment, but by comparison to some of those other things, it's a very, very predictable form of investment.
And I guess the benefit that property, why we tend to gravitate to property, and I think when we were talking earlier, Ashley, you said you think we could be some of the best property investors in the world, Kiwis, that is, not just Enable Me customers, but Kiwis. We tend to understand it more, but we also need to benefit from leverage, right? So shares do tend to outperform property if you aren't leveraging the assets, but when you compare the benefit of leverage, property outperforms all other asset classes by around 250%. Correct. And it's got the least amount of volatility. And that's kind of the unusual thing, right? Like if something's going to outperform by so much, then you normally would say, well, hold on to your hat because there's going to be a lot of volatility to get that outcome. But it's almost inconsistent because you have a much probable outcome with lower entry and less volatility, which is kind of
Probably
nice.
worth just explaining to some of your to some of the people who are watching this too what we mean by leverage, because it's a really important concept. So you're quite right. If you look at shares over the long term, over a 40 or 50 year period, I actually wrote an article on this a few months ago. The performance of shares in the long run, I think, has been better than property. It's outstripped most other forms of investment, notwithstanding the volatility that I talked about before. But the difference between shares and property in that regard is that if I walk into the bank and say, I've got $1 and I'd like to borrow from you another $6 in order to buy more shares, the bank manager will laugh at you. And so you've basically got to generate your own income in order to increase the value of your share portfolio. Whereas if I walk into a bank and I say, I've got $4 and I want to borrow 6 more in order to buy a house, the bank will say, here's where you sign. It's not quite that simple, obviously, but a bank will lend more on the basis of real estate because it's a trusted, securitable asset that's been around for a long period of time. And so what we mean by leverage is the ability not just to buy a property, but to borrow money for the purpose of purchasing that property in addition to any money that you might invest yourself, and then to enjoy the increase in the value of the entire property, even though a portion of that's been borrowed from the bank. That's essentially leverage explained. And why that's important is because it means over a period of time, that the gain that you make on that property far outstrips your initial contribution to it.
That's right. I think when we were doing some some data analytics on that, I think the nearest investment was 240% less than an unleveraged share that was performing at the best within the share market. So it's not that shares are bad and property is great. It's just that leverage is amazing. And most people's wealth plans need to have both, but at different times you bring in that layer of diversification. I think when we're planning for retirement, we're trying to get as much, because we need income to be able to live. We want as much of that income coming from reliable, the least volatile or stable forms of income. And the pension would be the first one, the most stable, I guess. And then your net return on your properties is something that you can bank on each week. And so you're trying to minimize what you take from your non-property assets, especially in moments like this, where they might be dropping in value. You don't want to be drawing too much from that, which means that your property investment needs to be reviewed to make sure it's still giving you what you need for that new stage you're in.
Correct.
We have some questions around whether we should be investing in residential property or commercial. And I'm really interested to see if you've got a view on that.
Yeah, well, I do. And my view is I don't claim to be an expert on commercial or a commentator on commercial. I mean, I have a layman's understanding of commercial, which is probably consistent with most of the other people viewing this. So I understand residential and I understand it probably as well as anybody does in the country. And therefore, it's my investment of choice. And that actually raises an interesting point, which is that if you're going to invest in anything, you either need to engage the services of, and this isn't a plug for you necessarily, but it probably be read as one, you need to engage the services of a business that know what they're doing and can instruct you in that regard, or you need to inform yourself and you actually need to know what you're investing in. And you know, it's interesting because there are all sorts of things that people have invested in during various frenzies in the past where they didn't necessarily really understand what they were doing and lost a lot of money. So it's actually important that you understand the nature and the basics of what it is that you're actually doing. So my basic understanding of commercial, and I'm sure somebody will correct me if I'm wrong, is that the basis upon which the property is valued is based on the rental that's paid on the property or the lease that's paid on the property, and that can fluctuate depending on what's going on in the market. I guess my biggest concern, and there are probably counters to this, but my biggest concern with commercial would be that while you can have an anchor tenant who can be in that property for a long time paying a lease, equally you can have a property sitting empty. And you know, I know, for example, here in Napier and Emerson Street, that there are a number of retail premises that have been sitting empty for quite some period of time, and landlords own those and are obviously eating their losses on those until they find another tenant. So for me, residential property, the difference between having a tenant and not having a tenant is the rent you demand. So all properties, assuming that they meet healthy homes criteria and a reasonable standard, all properties generally can be rented, provided you're prepared to meet the market. And that's not something you can necessarily say with commercial. So for me, it's a much more reliable and much more controllable and understandable market than anything that might happen in the commercial space. And don't get me wrong, there's lots of people that do really well out of commercial, but I'm not likely to be one of them.
Yeah, I think that commercial can work often with older clients where the wealth is stronger, where they don't need to borrow as much in order to get into the market. Yep. Commercial tends to require a 40% deposit. This is for the benefit of those who are listening, a 40% deposit versus a 20% deposit for residential new properties. Yep. It also has a shorter lending term. So with residential property, you tend to have interest only for a period of time, whereas commercial requires you to pay the mortgage off perhaps over 10 years, yep. which in and of itself isn't a bad thing. But what that does is it puts pressure on your own cash flow because you've got to come up with that extra $1,000 or whatever a week to pay that mortgage off, which is a good thing. But the probability of you being able to do that through higher interest rates starts to reduce. The more expensive an asset is to hold, the less likely you will be able to hold it, right?
Yeah, interestingly, Hannah, one of the things I hear from people too, I've got a few friends who've been residential property investors and they've moved into commercial and they swear by it. And one of the reasons that they give to me for having done that is I'll say that it's easier and they don't have the complications and the difficulties that they had with residential, which I always find fascinating because that suggests to me they tried to manage their own properties, which for me is an absolute no-no for a property investor. There are people who can manage their own properties, but it's a particular skill and not many property investors have it. So provided you're putting the property in the hands of a good property manager, you shouldn't have any more complications or difficulties with a residential property investment as you do with a commercial investment. So that's really not a legitimate reason to switch from one to the other.
Yeah, and I think what COVID showed us, right, was that when it all hits the fan, the yep. two costs that families will ensure they meet each week are their accommodation, their roof over their head, and their food. Yep. Absolutely. And if you're providing one of those pieces of lifestyle that's needed, then you're at the top of the pecking order as far as getting paid to provide yep. that accommodation to them. Whereas I know Absolutely. That some commercial properties, if your business is going under, it's not, you'd rather make sure that your family were housed safely rather than keep up your commercial lease potentially.
Yeah.
I'm interested, Ashley, if you've got any views on the bank situation. So with the CCCFA and how that's impacting property.
Yeah, so if I could just extrapolate that into a slightly broader answer, because one of the questions that'll be in people's minds is why did it also go so horribly wrong over the last 6 months when things were going gangbusters 6 or 7 months ago? Late last year, we as I mentioned before, we had FOMO. Two things happened to the market which completely changed the whole fundamentals of the market very, very quickly. The first of those was that that inflation became an issue worldwide. Global inflation suddenly took off. And the Reserve Bank, in its wisdom, decided that in order to deal to that, it was going to do what it's done in the past, and that is it was going to raise mortgage interest rates. And by doing that, it was going to squeeze liquidity out of the market. People would have less to spend on some of the things that they might have been spending them on. And the effect of that was that it would reduce inflation over time. That's a really crude instrument, but it actually works. And it will get inflation under control. And at some point, and the Reserve Bank governor seems to think it'll be the middle of next year, they will stop those increases in interest rates and that will cease to be an issue. And at some point beyond that, nobody knows when, they'll start bringing them down again. But the second one, and the one that had the more immediate impact is what you're referring to, and it was the changes that took place to the Credit Finance Act, the CCCFA, late last year. Now, interestingly, a number of commentators, and you may well have been one of them, Hannah, last year, was saying prior to the enactment of the changes to that legislation that it was going to have a deleterious impact on the market. It was going to basically tank the market. It was going to be almost impossible for banks to lend money. And that was ignored. And sure enough, that was exactly what happened once the legislation was enacted. Now, what's interesting about that piece of legislation is it wasn't introduced to deal with the housing market. And incidentally, neither were the increases in mortgage interest rates. The increases in mortgage interest rates were by the Reserve Bank to control inflation. The changes to the CCCFA were actually a hangover from some work that National had done some years ago to deal with predatory practices amongst sort of loan sharks and people that were of lesser reputations. But the banks got caught up in that. And the impact of that over the last 6 months is that you've seen these bizarre practices where banks treat savings as an expense. And, if you're spending too much on coffee, that reduces your ability to service a mortgage and a whole range of other things, which were patently ridiculous. In the last 2 or 3 weeks, the government has come out with an announcement on some changes that will be made, some modifications to that. They will take effect in July. The impact of those will be that the bank's lending practices won't quite go back to where they were in December, Hannah, but they'll be a lot better than they are now. So I would expect quite quickly, once the banks get their heads around that, to see lending practices basically resuming pretty quickly after that. So that will remove one of two major reasons that the market went in the direction it did over the last 6 months. And so as a result of that, and as a result of the Reserve Bank ceasing to increase interest rates beyond about the middle of next year, I think you'll find that there will be some normalization of market behavior at some stage over the next few months. I don't expect this current trend to continue. It might go a little bit further, but I certainly don't expect it to be sort of the downward spiral that you're reading in the media.
And when you use that term normalization, can you explain what you mean by that?
Oh, so, well, it has a couple of different meanings, but for me, so in respect of interest rates, what I mean by that is that there is interest rates are as much psychological as they are real. And that's not to say that they don't create a difficult position for people, but people responded to right at the beginning of this year, to the Reserve Bank's indication that it was going to raise interest rates, even though they might have had 9 or 12 months still to go on a fixed term interest rate on their mortgage. So although it wasn't affecting them straight away, it affected them psychologically straight away, because they knew at some point it was going to impact on them. So therefore it changed their behavior well before it actually impacted on them now. So what I mean by normalization in that regard is there is a point at which we just get used to that. We realize that that's happening. We kind of assimilate it into our behavior, and we get on with life, particularly given that the Reserve Bank's told us that there's a finite time within which this will continue and then it will stop. So I think you'll find that once people get their heads around that, they say that there'll be some people who are obviously quite severely affected by it, but for most of us, it will be a pain and it will be inconvenient, but it won't be the end of the world, particularly given that we know that at some point it would fall away again. We just don't know when that's going to be. So by normalization there, I just mean the psychology of it won't continue to have that very negative Chicken Little effect on us that it's had over the last few months. With respect to the CCCFA, normalization literally means normalization. It literally means lending practices going back to what they were prior to the introduction of that legislation late last year.
And with that lending going back, I know that some of our clients have experienced this, where the banks have been really tight in what they're prepared to let you borrow, and it almost feels, well, certainly insulting, but it almost feels a little bit unreal. I think I had a client that genuinely had like $100,000 a year in savings, and I think that they could, a huge equity in their home and maybe even a cash deposit, but they could only get like another $700,000 in lending. Like, it was just absurd. It was absurd.
What's interesting about that is because it was the big banks, obviously, that were sort of leading the charge on that stuff, and I know they were doing it because some of the potential penalties were quite severe. So the banks were obviously worried that if they didn't adhere to the legislation, they were going to be hit pretty hard. But the counter to that, which had the government not done what it's done over the last couple of months, would have become an increasing reality, was that banks are in the business of lending. They've got to make money. So at some point, that would have got more and more serious anyway, because although the banks were making it difficult, that's what they're in the business of doing. They're in the business of lending money to people that want to lend for a range of purposes, to borrow for a range of purposes. So this thing was always basically a disaster waiting to happen. And as you say, you had these crazy situations where people who three weeks prior to the enactment of the legislation, the banks were all over because they were the perfect client, suddenly had the door closed on them because they didn't meet this crazy new legislation. So the sooner we're rid of that, the better.
And I guess the benefit for that, for the property market, is with the lending normalised back to conditions 6 months ago, then some of that fear is removed from the market, or the inability to proceed is removed, which should help stabilise that market faster as well, right?
Yeah, and it can turn on a dime too. You know, there's two countervailing influences at work at the moment. One of them is, you know, and it's very easy to beat up on the media, and I probably shouldn't, but the media does have a bit to answer for in this regard. I read an article recently saying that the media was echoing what was happening in the market. It wasn't leading it. That's nonsense. It actually, you know, you get the impression sometimes when you read some of the headlines or listen to, you know, what's going on TV and radio, that there's sort of almost a salacious waiting for something terrible to happen, because it'll make a great story regardless of the consequences that might have on people's lives. But conversely, again, I used 6 months ago as an example of this. It can change really, really fast. You have 4 or 5 headlines talking about increases in property values or a change taking place in a particular region, and suddenly the whole narrative changes, and then everybody gets on the train, and that becomes the news story. And I've seen it happen so many times before. Incidentally, it's also worth talking about, because the other thing we hear about is this concept of a market crash. This word crash gets used. And for everything from commentators right through to, august international bodies that come in and talk about how the New Zealand market's ready to crash or ripe for a crash. It's worth noting that there's actually no accepted definition of a crash. Nobody's actually defined that. So basically take your pick. I've always defined a crash. For a long time, I picked my own definition, which was a crash would be a drop in 20% in the national median value of properties that would last for more than a year. Which seems to me to be a pretty reasonable barometer. And we've never got anywhere close to that. The GFC, we got to about 9% in Auckland, and that's about as bad as things have ever got over the last 40 years. So for me, if you accept that as a reasonable definition of a crash, we're not within a country mile of that. We might have a bit of a drop in values, still well above where they were in December 2020, but back a little bit on where they were late last year. When after a period of time in which the market had increased by an average of about 30%. So it's all relative, and for me, we're still in a reasonably benign environment, albeit a little bit more uncertain than it was a year ago.
Interesting. One of the things we were chatting about earlier was, which I think could be interesting for the listeners, was the types of property that you might need to keep in your portfolio is something that you might need to keep reviewing, right? Because not all properties, although we use average increases and average data, certain pockets of properties seem to do better than others, depending on whatever is happening in that decade, right? But if we're moving to, we've got a lot of baby boomers, say, that are going to be retiring at some point. We've got people who can't get on the first home ladder. We've got families coming together from multi-generational. We've got old properties, we've got new properties. Although we try and talk generally using data, if we actually go a couple of layers down, there are pockets of properties that do seem to be doing better or are poised to do better based on some of the specific analysis as it relates to that. Have you got any general comments on that?
I think it probably more in terms of the particular part of the market that your properties serve. And so probably the best example I can think of that is my first foray into property investment was back in the 80s when I was just out of my teens, and I bought a block of flats in Napier, and they were right at the bottom end of the market. And it was well before the days of healthy homes and all the other things that we're there to now. And the tenants were terrible. I mean, they were constantly doing a runner and not paying their rent, and it was just within about 2 years, I just decided I'd had enough and I got out. But if I'd had those properties for longer and been wiser, what I might have done was sold those and maybe consolidated, and because that had 4 units in it, maybe consolidated into 2 units of higher value. So that's a question that's constantly not so much top of mind, but it's a sort of a portfolio question that investors should be considering from time to time. Should they be looking at selling existing dwellings and buying new, for example, because there's some advantages and some benefits to buying new dwellings at the moment that don't exist for existing. So there's all sorts of reasons why people should constantly be looking to see whether the configuration of property that might have worked for them 5 years ago might still work for them in the current environment. And sometimes that's to do with the market, as it was in my case in the 80s. And sometimes it's to do with the financial incentives and benefits of a particular type of property over another. But that's a question we should constantly be reviewing.
Definitely. It would be something we'd encourage you to do every year because things change so quickly. I mean, when the last tax change came in, it was almost it was unprecedented and so fast. It was hard to anticipate, and I think it had the intended consequence, but no one was expecting it to be quite so dramatic. So that for some people that, although there was a phased approach to the interest deductibility rules, I've got some clients now where once that deductibility has been washed out, those properties are now going to cost them $50,000 or more a year in tax.
Yeah.
And if they swapped that property out with a new property for the exact same value, it might only cost them $10,000. So that then has ramifications to their surplus, to how fast they can pay off their mortgage, to what they can save for retirement, and all because of a change of policy that you've got to be able to respond to quickly, so you're not dragging the chain.
Incidentally, you're highlighting something there that I rabbit on about a lot in my articles, and that's the law of unintended consequences of government and Reserve Bank policy. And, you've seen over the last 40 years, you've seen all sorts of things that governments have tried to do to control the market. And it's a bit like a game of whack-a-mole where you whack the mole, but another one pops up somewhere else. And I've formed the view very clearly over the last 10 or so years, Hannah, that the best thing that the government can do when it comes to the property market in terms of the pricing of the assets is just leave it alone. It finds its own equilibrium in the medium term. So the government's best approach should be to focus on first-time buyers and stay well away from trying to control house prices.
Yeah, and we just took a question in just live now that said, well, what about if the capital growth rate's going to be the same on both properties? Why would you bother changing if it's still going to? The example there was double in a 10-year period. Why would you change? And I have an answer to that, but I'm really keen to see what you say first, Ashley.
Well, probably the simplest. There's a couple. The first of them would be and this is kind of going to contradict what I said before, but it doesn't when I explain it. Part of them would be the nature of the sort of property that you buy. So, for example, you might have a couple of flats that you bought 15 or 20 years ago that have provided a good return, and your growth on them has been steady but not spectacular. And you could sell those and put them into something that's more expensive, but it's likely to have a much higher rate of capital growth because of the kind of property that it is. And there's all sorts of examples of that. And the other one, which I alluded to, was if I want to buy another investment property and it's an existing freestanding dwelling, I'm going to have to come up with another 40% deposit, which I can secure against my asset if I've got a bit of equity in it. But if I build a new dwelling, I can do that with 10% deposit, which means that my buying power suddenly becomes greater. I've got more ability to leverage, to come back to the term that we talked about before. So there are different reasons why you might look at actually consolidating your portfolio over time, which it's always important with the stuff. You need to do the numbers and you need to extrapolate it out and see what it's going to look like in the medium and long term. But there are lots of reasons why different scenarios can produce a better result for you if you actually look at them empirically and cleverly.
Yeah, and I think that, I guess when you're assessing that, we just had a chat in from Amber, you're right, you need to be thinking about all the implications. So for some, if you sold a property, that could trigger a bright line tax. Yep. And so we've got to be mindful of that. We've got to be mindful of the difference in yields, potential capital growth rate changes, tax deductibility, repairs and maintenance, ease of sale, volatility of rent. These are all the things that you layer in when you're trying to stand up one property against each other. And if there's not much in it, I would take the view of, well, look, don't go through the faff of doing anything. But usually there are tens of thousands of dollars of difference, sometimes more than 100,000 over a 10-year period. And very few of us can afford to ignore that. Or even if you could afford to ignore it, why would you, when that could allow you to buy another property that would definitely give you more growth than leaving it as the status quo?
Incidentally, I see there's a couple of questions about the bright line test and the 10-year, the new 10-year rule, and why would you change because of the 10-year rule, which is actually a fair question. But a couple of caveats I'd put on that. Firstly, that there will only be a relatively small number of people. Actually, that's not fair, but there will be a number of people who are affected by the 10-year rule, but there'll only be people who purchased since the 10-year rule came in 12, 18 months ago. It wasn't particularly long ago. For people prior to that, it'll be the 5-year rule or indeed the 10-year rule, depending on how much longer ago they bought. So if you've been with that property for a long time, chances are that 2 or 5 years has probably passed and you're no longer going to be liable. But for those people who are caught by that 10-year rule, yeah, that's an obstacle for those folk. And so you would need to, as I said before, you would need to take that into account in your consideration of the economic benefits of changing. There's somebody saying 27th of March 2021. Thank you very much, which is when the 10-year rule came in. So for those folk who've got caught by that rule since 2021, yeah, you need to do the economics of it and make sure that it actually paid off, that there was some advantage to you in doing that versus waiting the 10 years. And look, let's be fair, that's one of the reasons, although certainly not the only one, why the government actually did that. But it's a pernicious and punitive rule, which hopefully will disappear if we get a change of government next year.
Well, it's an odd rule, and if we
Very
do
odd rule.
get that change of government, then I guess to that person holding that property, so you've bought it after that legislation's come in, I would be thinking that the value of that property is going to be discounted for forevermore because the future purchaser won't be able to claim any tax deductions on that.
Correct.
And my response to that, although I know that that feels uncomfortable me saying that, is realize the loss, get on, and let's replace it with something which we know is going to give you a greater probability of return, which isn't going to build in the discount. Because it's
That's a
almost,
fair argument.
and it's
That's a
almost
fair
like
argument.
those leaky homes or properties that look leaky, even though they're not leaky, they're tainted. And no matter what happens with that property, it's tainted for forevermore. And so
Couldn't agree
sometimes
more.
that's
Couldn't agree more.
what we're focusing on there. So it's a big decision, and we work it through to make sure you're comfortable with the optics and the comparisons, but sometimes taking the hit to prepare yourself for more is the safest thing you can do, not the most reckless thing to do.
Incidentally, just as a quick aside, it's worth remembering why the bright line test got existed. So when the bright line test first came in, it was designed to replace something called the intention rule that had been around for decades. The intention rule was a 2-year thing, which basically it was 10 years. And the Inland Revenue basically decided that they could go back and revisit a property investment at any stage for 10 years and determine whether you were liable to pay tax on it if you hadn't declared it. But the problem with that is that investors kept taking them to court and losing. The IRD kept losing. So the purpose of the original 2-year bright line test was the government's way of saying we need to tidy this up. Let's have a very simple rule that says first 2 years you pay tax. After that, clearly you're not speculating, you're an investor and you're in it for the long term, and no tax payable. And that was actually a really good rule. It tidied up, which was a confusing situation. When Labor came in, didn't understand the difference between investors and speculators, or did but didn't care because they were out to punish investors, and went to 5 years and then 10 years, and it became not about economic and taxation purity, but about punishing investors and silly nonsense and ideology.
Interesting. So I guess we'll take it. If there's any more questions on the floor, we can take those. But a couple of other questions that have come in around whether you should have a property manager, and I think we've both said yes. Why on earth wouldn't you? Because again, it's about increasing the probability of you keeping the property long enough to get the gain. And I don't know about you, but one of the things that creates friction for most of us is if that property becomes a bandwidth suck. If you've got to talk to tenants or do some of those things, it's encroaching on your limited bandwidth, which means it's less likely you'll want to keep doing that. So inserting a property manager actually increases the odds that it will become as passive as it needs to be to mean you hold it.
So don't get me wrong, there are people who buy investment property who are suited to be property managers and look after their own property. But for the other 99 and 100, it's probably that proportion. They shouldn't touch it with a barge pole. As I said before, I was a really good example of that. So my second foray into property investment actually didn't start all that long ago, about 2004, and I have religiously used property managers since that time, and it completely and fundamentally changes the whole nature of what I'm doing. Because that's the part of the transaction I don't need to worry about, and I'm a third party to it, and I can make decisions remotely without having to get involved in the day-to-day nonsense and focus on the bits of it that I actually like. So it's for the 6 or 7% or 8% or whatever the property manager charges, it's just a no-brainer.
Yeah, absolutely. I'm the same. I think my husband said he wanted to manage a property for us. Who knows why. And 2 weekends in a row, he was called by the tenant, and by the 3rd weekend, his response was, "We need to sell this property." No, we need to sell the property. I'm like, "Oh, we could get a manager." But I think, don't romanticize it. And I think one of the cool things about property is it can be an inflation-proof investment in the sense that your income can increase with inflation. But it does require someone to put the rent up every year. And Kiwis are terrible at doing that.
Yes. Yeah. Actually, it's interesting you should say that, because there's 2 reasons. One of them is we're terrible, when you're right, and a property manager stands in the market and does that. But one of the other interesting phenomena too, and I've noticed it enough to recognize that it's a thing, is we do tend to be a little bit more generous during times of high capital growth. And I suppose the reason for that, if the property's going up 50 grand a year, 100 grand a year, you're not too worried about an extra $1,000 in the rent. And we do tend to be a little bit more focused on getting the property manager to extract the maximum value out of the property during times when capital growth isn't strong. And that's interesting too, because I've observed that going back over the last 20 years.
Yeah, I think that they can be a godsend for so many of us, and but they have to be good. There are a lot of average property managers.
Oh, yes.
You want a goodie, but they can be the difference between whether you hold the property or not, which is important.
Yeah, no, I couldn't agree more. At some stage, that industry is going to be regulated, and that'll be interesting.
When are you expecting that to happen?
Oh, I would say, well, if these guys stay in another term within the next couple of years, if we get a national coalition government from the end of next year, maybe a little bit longer, but I think it's coming ready or not. And I'm disappointed because there's an opportunity for property managers to get together and actually do some of that self-regulation now. And to be fair, there has been some attempt at that. But not at the level that should be taking place to kind of cut that off at the pass.
We'll watch this space. Lots of things happening. Hey, we're going to wrap up now, but I just wanted to firstly thank you very much, Ashley, for joining us. Thank you for our clients that joined in. If you did enjoy this, we'd love to bring this to you more regularly. So just give us that feedback. But thank you very much, Ashley. It was wonderful to have you and to spar a little, as it were.
You're very welcome. Thanks, guys.
Thank you, guys. Thank you, Hamish. Thank you, everyone.